Well, welcome to this week's Rolling Trades podcast here. I'm Bob Haberkorn, Senior Market Strategist at RJO Futures, and I have Todd Fulton here with me, VP of Capital Introduction here at RJO, Brian.
Exactly.
What Todd does is help clients allocate funds. He runs a managed futures program, and I think it's a great opportunity to understand what managed futures are. A lot of people are pretty busy, and they look at futures trading as cumbersome sometimes, more hands-on than if they're doing equities. And what Todd does is help alleviate that.
Exactly.
Well, Todd, what are managed futures?
Formally, managed futures describes a sector of the investment community devoted to professional futures trading. These traders are called CTAs, Commodity Trading Advisors, and are licensed by the NFA, National Futures Association.
Who would invest in a managed futures account? I mean, why would you do it? What's the advantage to being a managed futures?
Great. That's a great question. The reason for my existence. Ultimately, the answer has to do with diversification. You mentioned busy.
Yeah,
in your introduction there. I think many people recognize the diversification value of futures generally to a broader portfolio. Somebody has $1 million net worth, they peel off $50K to day trade mini S&Ps, for example. The goal there is to diversify against what the rest of the portfolio is doing, of course. So when we talk about why, and we talk about diversification, one of the key components is correlation or non-correlation. I hate to go full nerd right out the gate, but there you go. The average Joe walking down the street is going to diversify his portfolio, and he's going to take 50% of his current S&P position, and he's going to throw 30% of it at the NASDAQ. He thinks he's master diversifier, and that's really not the case. When I talk about correlation, the NASDAQ and the S&P behave similarly about 93, 94% of the time. You're not really diversifying very much there. Whereas within futures, it's easy to get down to about zero, completely independent of what your current portfolio is doing.
Yeah.
So that attracts people, as you mentioned, to futures, but not everybody has time. Not for a second career. It takes some time, some effort, some research to trade futures on your own. Handing money off to the professionals is an appropriate solution for an awful lot of people.
Yeah, and the CTAs that you recommend to clients, I mean, are they regulated?
Mm-hmm. Exactly.
How is the industry regulated?
Yeah, the ultimate authority is the CFTC, Commodity Futures Trading Commission, which is the futures version of the SEC for the people at home not familiar with the futures industry. But we're more directly run by something called the NFA, National Futures Association, which is a self-regulatory body, and that's to whom we answer. So if there's a quality trader out there who would like to become a professional, become a CTA, they would pursue registration with the NFA. Yeah, and that's the path in.
And I could tell you that it is a process to become a CTA. I've had many individuals through the years ask to speak with Todd or attempt to become part of who Todd recommends, and it is a process. These people are the best of the best, and it does take a lot to become a CTA or registered CTA, and someone that Todd would actually recommend to you for allocate funds to. And I mean, for the documents, what kind of disclosure documents?
Well, one of the things
to be filled out for this, a
great point. Actually, let's go back to a previous point you made, because it was a really strong one.
Yeah.
Our role together in serving clients, a lot of it has to do with weeding out.
Yeah.
So, for example, Bob mentioned that it's a pretty strenuous exercise to become a CTA. There's a lot of hurdles. There's a lot of regulatory pieces involved, including the disclosure document, which we'll get to.
Yeah, I guess second.
But if an investor walks into our office with a burning desire to allocate to CTAs, a lot of what Bob and I are going to do is weed out. Just because they're licensed doesn't necessarily mean that we recommend them.
Yeah.
Doesn't mean that it's the right product for your particular needs. There's an awful lot out there, a lot of chaff to swim through before you get to the weed, But disclosure document and advisory agreements are two documents required by the NFA in order to hold a company out to the public. In other words, we're in business, we want your money, come in and talk to us. The disclosure document is largely informational.
Yeah.
Who am I? What have I done? What's my professional pedigree? How have I performed in the past? What goes into a disclosure document is dictated by the NFA. People tend to elaborate on that, but there's a minimum standard which includes a lot of the stuff that I just mentioned.
Yeah, and not to go back, but I think the main thing to drive home to individuals that are watching this right now is that how thorough and how vetted the CTAs are that Todd referenced. And, it's a very straight, transparent process to selecting these individuals. Mm-hmm. And, if you have funds that you're looking to allocate, that's a big thing right now. People are looking for individuals to help them manage money, mm-hmm. Especially in the ups and downs of the market. Whether it's a CTA mm-hmm. that trades grains, or a CTA that maybe trades precious metals, or just does the equity markets.
Sure.
You have CTAs that cover the whole spectrum.
Correct. That's definitely accurate. And again, you're bringing up so many great points. I want to jump back to a little bit about the rigorous nature of registration and maintaining that registration. One thing that's wonderful for clients, I think, not particularly great for you and I, is that in the post-COVID world, NFA audits have become largely remote, right? And by the way, NFA audits are when the NFA comes into a CTA's office and peeks under the skirt to make sure everything's kosher. Please go to the NFA website. You can learn much more about audits, but basically they're making sure everything's accurate. Right? So when I talk about the post-COVID world and audits being largely remote, that extends the depth of their investigation. Mm-hmm. So back in the day, I ran a CTA for many, many years. The NFA would do on-site audits, and they'd come into the office for roughly 3 days, possible additional days, depending on what sort of registration that company had. Let's say 3 days for a CTA. Monday morning, start asking questions. They leave Wednesday afternoon at 3:30 because they got somebody else on Thursday morning.
Sure.
So there's a limited time window for investigation. They'd certainly come with follow-up questions or requests, but it was somewhat delineated.
Yeah.
Now that they're remote, we can reach out and touch someone 3 weeks, 6 weeks, 4 months, which is ultimately a protection to the client.
Yeah.
As onerous as that may be to industry professionals, ultimately it's protecting clients. So sorry about my digression.
No, that's all. No. But another big thing that will come up are what fees are associated with managed futures with CTAs. Can you explain that?
Oh, absolutely. We talked about disclosure documents. The second piece of paperwork required to engage a CTA to trade on a client's behalf would be the advisory agreement. And in the end of the day, the advisory agreement is just a contract between that client and that trader. What are you going to do? How are you going to do it? How much are you going to charge me? How do I start and stop? All those nice things. By the way, the disclosure document is rich with information. You should read all of them. When you get to the advisory agreement, there will actually be a page there saying, I read the disclosure document. So if you're going to sign and say you did, you might as well go ahead and read the disclosure document. I strongly recommend that. But back to your question, the advisory agreement includes the fee structure that the client will be charged. Generally, that takes two forms. One is a management fee. Another is an incentive fee. A management fee is a set fee, percentage of the account value, charged calculated annually and charged quarterly. So, for example, if there was a 2% management fee, that would be annual. Roughly speaking, they're going to charge about 50 basis points or 0.5% quarterly. The other fee involved is called the incentive fee, and that's generally 20% is a common number. And that will be 20% of any new profits made for this account. Now, what do I mean by new profits? That's important. I'm going to do a very, very simple example. You'll have to dig deeper.
Yeah.
Client opens an account with a CTA, and for the sake of this discussion, they're paying 0 and 20. No management fee, 20% of the incentive fees. Okay. The end of the first billing period, that CTA has made $100K account made 10% or $10,000. Okay. Easy math. $10,000 profit, 20% is $2K.
Yep.
After the fee payment is done, that account is left with $108K. Easy peasy.
Yeah.
Now, during the next cycle, the CTA loses $10,000. Right? And that's sad, but we continue on with this trader. During the third billing cycle, that CTA has to recoup all the losses and get to a new high before the meter can start ticking again.
Gotcha.
So if you end up with a CTA who's very volatile, up and down, sine wave performance, you're not going to absorb all the losses and then pay on every rally. It just makes sense, but it's important to understand. So in this case, the third billing cycle, the CTA makes $11K.
Okay.
Only $1,000 is billable, so it's $200.
Gotcha.
Anyway, so that's sorry to apologize for going
very
full nerd. But.
No, it's very straightforward. It's in the disclosure docs. The fees associated with it. It's not an investment that you're going to put money in and wonder how what's in it for the CTA. Where is it? It's very transparent. It's very transparent. We like transparent. How do investors monitor the accounts that they're if I open up an account with you, I sign on with a CTA, how am I able to monitor the performance on a daily basis?
Yeah, that's a great question because of the contrast it exists in the alternative investment community. So for example, and in your segue of the use of the word transparency was beautiful there. You should be a talk show host.
Oh, I don't know about that.
Transparency is key. Let's talk a little bit about how it actually operates and works. Tomorrow, the Bob Family Trust wants to allocate to a CTA. How's that going to look? Well, it's still, the Bob Family Trust still has the account.
Yeah.
In Bob Family Trust name. Bob Family Trust is the only person with access to funds in this account. Okay, which is a wonderful, makes one feel good that no one has access to the funds.
Yeah.
Well, all that's been done there is that the Bob Family Trust has assigned trading authority over that account to a third party. So let's get back to transparency. Just like your personal account can log on to Armor, our in-house account monitoring platform, can watch the account 24/7. You can sit there like a rat at a feeder bar, hitting refresh, to keep close tabs on this. After a short time, I think you'll probably stop doing that, but that's available to you, 24/7 access. Same thing, library of statements. Comes tax time, you don't have to call your broker. You can go right into Armor, pull that, and off you go.
See,
not waiting anywhere. Liquidity is another key component of managed futures. And this is when I talk about contrasting with other segments of the alternative community. With a hedge fund, very often there's a minimum hold period.
Ooh.
You invest in the product, you have an 18-month, 24-month minimum hold period. Your money's trapped. You can get it out, you're going to pay a penalty. Right?
Yeah.
Then once you've achieved that hurdle or surmounted that hurdle, then you might have monthly liquidity. You can only get in on the first, you can only get out on the 30th.
Yeah.
All right, well, if that's the rules, that's the rules. Well, managed futures accounts are very different.
Yeah, it's
Not only do we have the access to what's going on in there, I can hire a trader on a Monday and fire him on Wednesday if I don't like the cut of his jib or what he's doing or why'd you sell silver today?
Yeah.
That sort of thing. One would hope, this isn't a mutual fund, getting it out in and out that rapidly would be a little bit ridiculous.
Or can a client...
But it's reassuring to the client.
Yeah. Can a client that opens up, which starts a CTA on a Tuesday, decides over 48 hours, this is not right for me, I don't want to do this.
Mm-hmm.
Can they close the account out, is there a limit or a time frame they have to be in it?
The short answer is no. There's generally no time limited hold periods or anything like that with the separately managed accounts. Some CTAs will put that into the document. That's a matter for discussion between the client and the CTA. But generally speaking, you can get out almost instantly. Now, in such a case, you want to get out on Tuesday or whatever day it is, it's really just a question of are the markets still open?
Yeah.
You call it 1:18 to fire your grain trader. Well, the grain's closed 3 minutes ago.
Yeah.
When it reopens, I'll get you out, that sort of thing. But I think it's reasonable to expect that all positions would be offset as soon as possible, and including foreign positions, which might be closed and open at midnight Chicago time. I think all positions being flat within 24 hours is very, very doable.
Yeah.
I would assume much faster than that, but let's just use 24 hours as a rule of thumb.
Yeah. And, like we're going back and forth with managing funds. I did read, I don't remember where it was this week, might have been Bloomberg or Wall Street Journal, about family offices, coming down here in the future are having a hard time finding people to manage funds. It's really getting to be a process here for family offices to manage funds. The nice thing about Todd is Todd can work with family offices if you're fortunate enough to have a family office.
Mm-hmm.
Or even just individuals. So there's a lot of, to manage funds for someone to help allocate and a professional to get you through these markets is such a valuable asset. And we rely a lot on Todd. We have a lot of clients that are looking for that extra service. And, Todd is a wealth of knowledge when it comes to managed futures and the CTA space, who's the real deal out there. There's a lot of people that claim they claim they are, but Todd knows who they are, and is a great resource if you're looking for something along those lines.
Along those lines, not to toot one's own horn.
Go ahead.
I've been doing it for 30 years, only this.
Yeah, you've seen it all.
Yeah. I have active relationships with probably 30-ish CTAs at the moment. I have allocations via my customers in 30 different products. I have semi-active relationships with probably another 30 on top of that. And I probably do something like 100 interviews of new products every year. So I try and keep my fingers in the cookie dough or whatever.
And it's all I do. Of course, Todd, you're a good guy. You're looking for good guys, be CTAs. It's good. 30 years is a long time in this business.
Long time.
If you want to get in contact with Todd or myself, our information will be up on the screen, or it should be down there somewhere. You can always reach out to us. Anything else you want to touch on when it comes to managed futures, Todd?
No, I think this is a good running start. I mean, obviously we didn't say buy this, sell that. You need this, you need that. What we're really trying to do here is lay some groundwork for further investigation. So education. If you decide that you're interested in managed futures, you can probably have another 3, 4, 5 calls minimum with each of us before we actually take action. We do a lot of homework beforehand, because ultimately the most successful clients, and we want successful clients, are the ones that are best educated pre-investment. I can't emphasize that enough. I will over-explain. You've seen me do it in this clip. I will over-explain things 26 times to make sure a client grasps it. Because after the investment occurs, the worst thing that can happen is a surprise.
Yeah.
I didn't know there were going to be trading options.
No.
They didn't know.
And one of the best things about Todd's space, too, if you like to geek out on trading, track records. For Todd to show you some of the track records of some of these CTAs that he's using. I mean, I love looking back at them and seeing what they've done. You look at trading through OA, a lot of the ups and downs of the markets, just to have access. If you have questions, how did, this particular CTA do during the crazy days? It's so interesting to look at track records.
Well, and you bring up an interesting point. Bob and I are working with a particular client right now, and his intention is to make a reasonably sizable allocation to managed futures, but there's a lot of drama going on in the market. Yeah, a lot of news-driven, tweet-driven volatility has occurred. And this client has decided, you know what? I'm going to pause for a second.
Yeah, wait, see,
push this off a little bit, which is great. And so what Bob and I will do is take the recommendations that we've made. We'll do monthly or quarterly performance updates. Here are the guys that you've been looking at. Here's how they've done this during this period. Just keeping you informed. Give us a call when you're ready to pull a string.
Yeah, just keep you in the loop.
Point being is, we're not used car salesmen trying to get X sold. We follow the client's time frame, I guess is what I'm getting at.
Yeah, it's
reporting for 3 months, 6 months, a year. It's just not that big a deal.
No, not at all. Well, I think we covered it all here, Todd. And of course, if you have any questions, I'm sure many of you had many other questions, but if you do, you can always reach out here to us, to myself or to Todd, and we'd love to explain a little more in details and answer anything specific that you may have. Thanks for joining us this week for the Rolling Trade podcast, and don't forget to tune in next week.
Thank you very much.
Thank you.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.